Today, we're diving into a stock that has Wall Street completely split. I'm talking about PayPal. Is this fallen tech giant a brilliant once-in-a-decade buying opportunity, or is it a classic value trap just waiting to spring? Let's get into it. So, here's the game plan for breaking this all down. We're going to start with one investor's absolutely massive all-in bet. Then we'll unpack the bull case, both the numbers and the big picture vision. After that, we'll flip it and hit the bear case, see why people are so skeptical, dive into the heated debate, and finally, we'll try to answer that huge question: is this a smart play or a trap? So what kicked off this whole firestorm? Well, it starts right here with this absolutely wild bet from investor Ryan Daniel Moran. He put a huge chunk of his own money into one single company, the biggest bet he's ever made in his life. $180,000. I mean, a bet that big, it just forces you to stop and ask, what company on earth is worth that kind of conviction right now? And the company he bet the farm on? PayPal. Yeah, PayPal. For a lot of investors, PayPal is just old news. It's seen as this kind of boring, slow-growth company. But that's exactly what makes this whole thing so fascinating. Why would anyone go all in on a stock that the market seems to have completely forgotten about? In this timeline, wow, it shows you exactly why this debate is so intense. You see it peaking at over $300 a share in 2021, and then it just falls off a cliff, an 80% drop. Now the bears look at this and see a company in a death spiral. But the bulls, they're looking at this like it's the Black Friday sale of a lifetime, a chance to scoop up a hugely profitable company for pennies on the dollar. Okay, so let's put on our bull hats for a minute. What are they seeing that everyone else is missing? Well, it all starts with the math. For value investors, a good story is great, but the numbers have to work. And with PayPal, the numbers are, well, really, really interesting. It all starts with this number, nearly $7 billion. That's the cash PayPal is expected to rake in this year after all the bills are paid. Think of it like the company's take-home pay. This isn't some startup hoping to be profitable one day. This is a straight-up cash machine right now. This chart just shows you how disconnected things are. PayPal is trading at a PE ratio of 15. That means you pay $15 for every dollar of profit it makes. Now look at a high flyer like Palantir. You're paying $75 for every dollar of its profit. The market is basically valuing PayPal like a boring old utility company, not the tech powerhouse it is. Okay, so here's how the bulls get to a potential 10x return. It's pretty simple, actually. They say, look, if PayPal can just grow its earnings by a pretty reasonable 15% a year, which is less than it's done in the past, its earnings per share would jump to around $16. Now, if the market just starts treating it like a normal tech company again and gives it a PE of 30, boom, you're looking at a $600 stock. That is a massive return from today's price. And here's the cherry on top for the bull case. The company is literally betting on itself with a gigantic $20 billion share buyback program. At today's super low price, that's enough money to buy back and retire almost a third of its own shares. That should make every remaining share that much more valuable. But look, cheap numbers aren't enough, right? You also need a vision. You need a story that explains how this company is going to get its groove back. And under a brand new CEO, PayPal is trying to write a really compelling new chapter. The new strategy, led by CEO Alex Chriss, is all about evolving. The big idea is to move beyond just being a button on a checkout page and become an entire commerce platform, a total toolkit for the people who really drive the economy, small business owners and entrepreneurs. And their comeback plan has 3 key moves. First, they're rolling out Fastlane Checkout to go head-to-head with the super smooth one-click experience you get from Apple Pay or Shopify. Second, they've launched their own stablecoin, which is actually a really clever way to make money off the cash reserves backing it. And third, they're finally going to seriously monetize Venmo and its massive base of over 50 million users. Okay, that all sounds pretty good, right? So why isn't the market buying it? Let's flip the coin and get into the bear case, because you have to understand why so many people think PayPal's best days are long gone. And it really all boils down to one word: competition. For years and years, PayPal was the default choice. You were buying something online, you clicked the PayPal button. Easy. But that world, it's over. Today, payment options are baked right into our phones, into our browsers. Apple Pay, Google Pay, Stripe. They aren't just other options, they are part of the ecosystem, and that is a huge, huge threat. And this quote from an investing forum just sums up the fear perfectly. The concern isn't just about losing a little bit of market share. The real worry is that a giant like Apple could make PayPal completely irrelevant. For a lot of folks, that risk is just way too big to take. So let's dig a little deeper into that skepticism, because the bear case actually goes beyond just the threat from Apple. A lot of long-term investors have some really serious problems with the company and how it's been performing. And the biggest frustration you hear over and over is this idea of dead money. Think about it. For years, PayPal has been reporting good earnings, it's been buying back its own stock, and yet the share price has gone absolutely nowhere. The company is making money, but the shareholders just aren't seeing any of it. And this leads to a really critical challenge to the whole bull case. We heard that the $20 billion in buybacks was this huge positive, but the bears are asking a very tough question. Are those buybacks actually doing what they're supposed to be doing for investors? And here it is. This is the bombshell that really fuels the bear argument. One investor pointed out that a massive chunk of that buyback money isn't actually helping shareholders at all. It's just being used to cancel out the billions of dollars in new stock that the company is giving to its own employees. So it's like they're barreling water out of a boat with one hand while pouring it back in with the other. So all of this, it just brings us right back to the central conflict. After hearing from both sides, you're left with two completely opposite stories for the exact same company. It's kind of wild. So here's what it all boils down to. Is PayPal a deeply misunderstood, cash-rich company that's trading at a ridiculously cheap price and is on the verge of a major turnaround? Or is it an old-guard tech firm that's just being slowly squeezed out by more innovative giants, using financial tricks to hide its deeper problems? And that, right there, is the multi-billion-dollar question. The numbers seem to scream that it's a bargain, but the market's fear and the competitive threat suggest you should be extremely careful. The evidence is on the table, and now, the final call is yours.